Interested in real estate? How about wealth? Well, they go hand in hand. And here, you'll learn all about it. Welcome to Be the Bank, a podcast where we discuss and debate the topics centered around real estate investing. Your host, Justin Bogard, shares insights into investing in real estate to create real wealth and passive income for you and your family. He'll share stories of real estate investments done right, walk you through the process of owning a real estate note, and most importantly, educate you so you can be the bank. This is Be the Bank, brought to you by American Note Buyers. Now, here's your host, Justin Bogard.
Welcome to Be the Bank podcast, season number 5, episode number 20 today. Richard Thornton is going to be talking with us. And one of the main things that we're going to discuss today is kind of what does it look like to be in a portfolio like a fund or versus owning a couple of notes. And we're going to dive into some specifics on that. So stay tuned. Hey, dude.
Hey, I was worried there for a section because I heard the little fellow talk in the opener, and I thought he said with your host Jackson Bagard, and I thought, wait a minute, something got screwed up here.
It must be a latency issue. Those of you that are listening to us, we record this podcast via our YouTube channel, so you can check out American Note Buyers YouTube channel so you can see what's happening. Pretty much Richard has this ongoing problem with his computer where all of a sudden his camera works, but it doesn't. And what I mean by that is that I can see Richard on camera, but he can't see himself when we're on the application we're using to record this. So it's also given him some latency issues. So when he's speaking, his words come through quicker than his mouth is moving on the camera that we're seeing on the video recording. So it's quite interesting.
I just need to think faster.
Yeah. Or maybe have your think fast. Yeah. Think faster than your words come out slower. If you're able to move your mouth before you talk, like a half second, like it would work perfectly.
Telepathy is a good thing.
so
which we may be at. So Musk is, now experimenting with silicon chips implanted in brains, and they're doing it for people with disabilities. But what's coming down the road is the Borg. So when you want to invest in notes, you'll know what notes are immediately available because if you talk to the Borg, you'll have a ready-made market. And I am sure that investing in notes will be at the front of that list.
It better be.
Forget this stock market crap and all that. I mean,
Well, speaking of the stock market, that's when I get the most interaction with people is when the stock market starts going sideways or when there's, I'm using air quotes here for those that can't see, the fear. When the fear is out there about the economy possibly going bad or something is wrong or with real estate, like people just get worried, and it's just quite interesting. So I don't know about you, but for those of you that don't know, Richard is in Petaluma, which is in California, and I am in Indiana, which is the Midwest. So we see two totally different types of individuals, investors, and even housing and real estate. So we always think it's comical how we compare and contrast things and just think it's just the polar opposite, really, right?
Very much so. I don't know. I won't digress too much, but they say the housing market's cooled down, and I know it's cooled down some places, and it seems to have cooled down here. And then I keep getting these notices in the mail, like the realtors send you, and we get houses that are being sold for $100,000 or $200,000 over asking still. Yeah, I'm going, what the heck? I don't get it. I mean, it's such a jumbled market out here. It's just amazing.
It's a new frontier for us in the real estate world. I believe and I wasn't investing in the 08, 09, and 10 era, but you obviously were. Mm-hmm. I'm sure it was at that standpoint, you were like, I don't know if I've ever seen anything like this before, nor will I ever go through this again. And I think we're all saying the same thing now.
Yeah, in a very different way, but yes, I mean, things are just a mess. Markets are a mess right now, and there's a whole lot of tumult. That's the best way to put it. I think there's some little hot spots in some places and not in others, and it's just a whole lot of. It depends totally on what's going on. Like we've got a whole bunch of old houses out here. I mean, when I say old, I mean my whole neighborhood. A lot of the stuff is built, 1860 to 1920. Oh, I don't know.
That's interesting.
But your previous comment about the jitters in the market is called flight to quality. That is the overall term, and a lot of people start buying CDs and things like that when they have so much tumultuousness in the market. I think that there is a bit of a, as you've said, a bit of a flight to quality in investing in notes, and especially investing in a fund, because if you look at the difference between buying individual notes as opposed to buying in a fund, the fund's easier and safer.
It seems to be a pretty almost clear answer for investors that I've talked to recently, because of that fear and that they see the economy feels like it's going down, even though we know it just really goes up and down. And that is a cause for concern, is like, where can I put my money to get just a modest return? And where can I put my money to where there is a safety net behind it, to where I know that there's a hard asset supporting it? And obviously, our fund is buying real estate notes across the country, and all these notes are secured by real property, traditionally residential property.
Yeah, well, I mean, when you look at it, so I talked about this. For those of you who don't know, I'm making a small series of videos regarding investing in funds, and basically it's note investing 101. But one of the things I mentioned in there, and I did a little research to back this up, is that a lot of is that I compare what we're doing, since we are investing, and especially we're in a fund, to investing in municipal bonds. Why is that? We are asset backed. So yes, we as a fund may have a little problem disposing of a property, but guess what? You still got. I'm going through that right now with the property. When I bought the note, the property, I was at 50% loan to value on the house, and we're now selling the house, and the house is right now it's at about 30% loan to value. So even if that defaulted, I'm going to get out very well. So to me, that actually is quite comparable to buying a municipal bond. You don't have the credit worthiness of a city or anything like that, but you got a lot of there. And so what kind of yield are you getting on munis? Well, munis are 3 to 5% right now. Well, the fund starts at 6 and goes to 8.5, right?
6.5 to 8, yeah.
I almost had it. Right?
A couple %half off on either side.
I was short on the bottom and long on the top, so I almost got it.
You're being too generous, all right?
Yeah, that's right.
Pull it back.
That's right. So anyway, I think a lot of people need to keep that in mind, especially when you invest in a fund as opposed to a one-off note.
The management of it's a lot different too.
Oh, totally.
One-off versus a portfolio. So if you have time for it, then obviously build yourself a note portfolio. That'd be great income for you and keep things going, and you can be pretty active in the business. If you don't, a fund's a great way to do that because somebody's doing that for you. And quite frankly, if in a large portfolio in a fund, if one note goes bad, the rest of them just absorb kind of that bump in the road. So I described this to somebody earlier today when I was talking with them, and I was just like, you imagine you're going down the road and the fund is a shock absorber. All the other loans in there are just shock absorbers. So once they go over a bump, they just, the tires and the suspension kind of compresses and then it decompresses once it goes back over it. So I think that's a real good analogy to show like how it's pretty resilient overall. And that's why we buy assets that are, the 125 to 50,000 range assets as far as the UPB that we're buying, the unpaid principal balance. And that really helps us as opposed to having a $10 million fund and you buy 10 $1 million mortgages. Like that doesn't make a whole lot of sense, right? Because if one goes down, you lose 10% of your portfolio. Well,
right. Right. Yeah. And so also one of the responses I get quite often is, well, if I can go out and buy a note myself and get a 9% yield, why should I do something with you guys and get 6.5 or to 8? Well, there's a pretty good reason. And you just went through some of those. You can be a yield hog or yield drunk on yield. And and if you look at the actual dollars, per 100,000, if you get an 8% yield versus a 9% yield, so you've got $1,000 difference, and is that worth
You're
the headache?
working a lot. Yeah, you're working a lot harder for that extra juice. So
Yeah. And
it's
do you have to go through the foreclosure, and do you have to? Yes, you're going to get your money back, like I was just
yeah.
talking, but there can be a lot of headaches between here and there.
That's a pretty good comparison. I don't think we've done that before, but I like what you said about that. And when you're first starting out in the business and you really want to do this full time, that's okay. Go ahead and do that. Right? Buy a few notes and start getting your teeth cut in the business, and that's fine too. But a lot of people get into this for the knowledge, so that they feel reassurance that this is the right investment for them. But then they figure out 9 times out of 10, they don't really want to do it full time or have the time to do it after their 9 to 5 job. And they just end up having that's why we had the fund so aggressively priced for return for investors, because we want them to, get into the fund, because it just makes everything better for the rest of us. We'll get better deals now. We can buy at bigger discounts. We can buy in bulk. We got all those advantages now of having a larger bankroll, as opposed to, when it's just you and I in there, we're suffocated on capital. We only have so much that we can use.
Right. And it's a little bit like, so do you want to consider yourself a portfolio manager or actively managing a portfolio? Well, what's the difference? If I'm a manager, if I'm going to be a manager at a job, I'm going to go in and I'm going to want to do the job for a while. I don't care what it is, if it's plumbing, if it's installing, certain types of pipes, or if it's running different types of analyses I worked for a syndicator for a while, so I did nothing but run spreadsheets, and I knew the investment and I knew the spreadsheets in and out, and I really knew what made the numbers work. And it wasn't until after I did that myself that I could step up and start to become a manager of other people doing that for the company.
Yeah.
Well, investing in notes is a little bit like that. Sure, go out, cut your teeth, get to know the product before you step up and become the manager of your own portfolio and putting your money with a fund or something. So, because then you can say, oh, I know what those guys are doing. I know what's involved. I know why I want to be just a manager and not down in the trenches.
That's a great explanation there. I was talking to somebody recently about, and this is one of my new pet peeves about flipping houses and fixing and flipping them. Like, I get it. Some people can make some money, and on paper, sometimes the deals look really good when they're done with the ROIs, but living through it.
Yeah.
Like what you said was great, because I fully believe that's what we should do as managers, is we should actually do the work, do the job, so we can understand it. So if we find, simpler ways to do the process or build a better system running, and obviously you're going to have good knowledge on how to do that. But yeah, I just don't get how fix and flippers actually make and sustain money because of how much time they put into it that you can't really put a dollar value on. And at the end of the day, which one of my other pet peeves, at the end of the day, right?
Mm-hmm.
I don't think you really make money.
Well, so that's why I got out of it. When I was flipping houses years ago, I got out of it in 2016, I think, 2014, 15, somewhere in there. I was making 50 to 70% on my flips. And I said, if I can make that kind of money in a 6-month period, because that's start to finish, buy the house, do the reconstruction, renovation, and actually be sitting at the closing table. That's what it was taking. I was willing to take all those risks that you talked about. But when all of the weekenders got in there and yields started going down, and you got the market being where it is right now, where a lot of flippers are happy with a 15% return, I'm saying, no way. No way am I going to have those sleepless nights. Am I going to wonder if my HVAC unit's going to blow out? and I'm not going to be able to sell the property, or whatever it is that goes wrong. I mean, renovation is renovation, right?
Yeah.
It is a big world of unknowns. I agree with you.
Let's switch topics quickly, but along the same lines, and talk about the lender in those situations. So, lending short term for a fixed flip project, because that's kind of your area of expertise, is what we also called hard money, meaning Richard is going to lend money out, or anyone can lend money out on a project, knowing that the balloon is due like in 11 to 12 months. And
Now,
usually
the new
interest only.
PC, the new PC term is private money, not hard money.
It's always been private and hard money. I never knew which one was right or wrong. So I hear more hard money. Do you hear more private money where you're at? Because I always hear hard money.
Yeah, I hear private money, and they say, "Oh, you want me to make a hard money loan?" You go, I mean,
no, I said private. I don't know.
Yeah, exactly.
No, I don't want anyone to know about this. This isn't public. This is a private loan.
Everybody, it's hard money. But
yeah.
So go ahead. I interrupted you.
I don't know what I was going to say. I was just trying to compare the lender and say,
I think a little bit. Yeah. Like, so when I'm doing my different networking groups and things like that, people ask me the legitimate question: why should I invest in a long-term note where I'm going to make, I don't know, 9%, 8%, whatever it is?
There
10%,
we go. Okay. Let's go down this path.
Yeah. Versus 12 or 13 in some cases out here from a flipper.
Well, we're talking about interest rates. Let's clarify this. We're talking about interest rates. So when Richard says 12 or 13, he's saying just the interest rate annualized 12 or 13%.
Right. So, I mean, the first glaring factor is that if you're only making let's say if you're making 9% or 10%, you're making that all year long. Whereas, and for many years, whereas with a flipper,
on investing in a note, right?
Right. Investing in a note. Whereas if you go and you invest in a hard money or private money loan, your money's probably only outstanding 6 to 8 months at the most. And yes, you're making 12%, but then can you get it reinvested? There's always going to be a latency period there of at least 1 or 2 months before you can get it reinvested in the best of cases. So if you look at your annual yield, it's not actually 12%. It's, what you got in your pocket at the end of the day is probably closer to 10.
Yeah, there's drag on that.
Yeah. So that's the one thing. Another thing, which I think is, especially out here in California, a lot of people have been lulled into, is that they do not realize that when Joe Renovator or Jesse or, him or her, whatever the names are, put in $500,000 on a house, and you're making a loan that's 75% loan to value. As soon as you do that, as soon as they get into the renovation, you are overlent. You are lending at that point probably 130 or 140, if not more, percent of the value of the house, because they've got all ripped to shreds, and nobody's going to want to go in and it's not worth what they paid for it at that point, because it doesn't have drywall, it doesn't have a kitchen, it doesn't have whatever it is they're doing. So you've got a huge risk period there, and that's actually inevitably why I got out of the market. The market paused for a while, and I realized that I had debt service of $10,000 a month that was sitting over my head. And if the market didn't turn around quickly, I was going to be underwater very quickly. And a lot of people don't perceive that risk because they haven't been bitten yet.
High risk, high reward.
Yeah. And a lot of, there was a lot of, in 08 and 09, there were a lot of hotshot private lenders out here that, basically were driving Beamers and Maseratis and thought
they act like they had it all figured out too.
Yeah. I mean, and I'm not talking about the subprime guys. If you want to see, what the subprime guys are doing, just watch The Big Short, because they portrayed it very well. Those guys were out there making loans and buying trailers and boats and, all sorts of stuff, and they had no idea what they were doing. These aren't the subprime guys. These are guys that said, I'm investing in 65% loan to value, and I know what I'm doing, and la, 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 la. And they all went south. I mean, this is not an exact numerical number, but I'd have to say that probably 1 out of 10 private money lenders made it through that period.
That makes sense.
Anyway.
Yeah, because you're investing into the current as is value of the property. On top of that, you're also financing some of the rehab work. So you're banking on the appreciation of the asset from when it was purchased at the closing table and you originated the loan to when it's actually going to be finished. And you don't know if it's going to get finished. And yes, you have a draw schedule. And you don't have to give them all the money up front, but you still have that high risk factor of you've got a lot of money into this project that isn't really finished. And so not only are you banking on the value of the home being sold at a higher rate, but you're also banking on that individual that's borrowing the money, that's GCing the job, that they're going to do it right. So there's a lot more risk that people maybe don't realize that's, on the surface there.
Yeah, it's a game of musical chairs that you may not realize.
That's a good way to put it. Yeah.
Yeah, you may not realize you're playing it, because if the music stops, guess what?
Yeah, you better find that chair.
You better find that chair, because everybody else is going to be trying to find that chair, and somebody's going to be out.
Yep.
And that's what happened out here in 08 and 09. And we had a lot of very nice properties that were just all of a sudden worth half, if that.
Jeez. All right, Richard. Well, we are just running up on the clock here. I think this is a good stopping point for our conversation today. Thanks for being on our podcast again. Obviously, this is episode number 20 of season 5 of the Be the Bank podcast. You can check out our American Note Buyers YouTube channel to see the video stream of that and all the videos that we do as well. And Richard's video series will be up there shortly as well. So we got that going for us. Richard, I will catch you later, my friend.
See you soon. Bye.
Thanks for listening to Be the Bank. We hope you learned something from today's show. If you enjoyed this episode, please rate and review us. Plus, check out our channel on YouTube and follow us on Facebook and Twitter at Be the Bank and on Instagram at Be the Bank Podcast. Be the Bank is sponsored by American Note Buyers. Thanks again for listening.